I think it's the combination of poor bond returns over the last few years and outsized equity returns that all of a sudden everyone wants to jump on that trade. Time to jump on that trade was a few years ago. Now you want to kind of think the other way, which is overvalued, which has value.
That's the interesting thing, right? That's human nature though, Mike. We want to buy whatever performed well last year. We're not looking at the future. There was a comment in chat, bonds aren't safe. That's ridiculous. Bonds are absolutely safe. You buy treasury bonds, you're guaranteed to get your money back. There's no other asset that's going to give you that. Equities aren't safe. Gold isn't safe. Silver's not safe. Bitcoin's not safe. You can suffer massive drawdowns in those assets. Bonds are going to give you your money back. How is that not safe? Ridiculous comments and uneducated at best. So these are the narratives in the markets. This is the stuff that's making people make poor choices, saying, oh, I need to go out and buy the most overbought asset right now because it's going up, and ignore assets that are cheap. Staples are very cheap right now. Utilities are getting very cheap on a fundamental basis. Energy stocks are cheap on a fundamental basis. There are some asset classes out there that are going to give you outsized returns going forward based on their current valuations.
What if we just said, you know what? In your equity portfolio, you only need to own 7 stocks, the Magnificent 7. Don't bother with anything else. It's the same thing, but we do own utilities. We do own staples. We do own those more conservative sectors because they provide ballast. And look, this market isn't going to keep going up forever, despite what some people say. And it will go down. And the equity market can fall 20, 30, 40, 50, 60, 70% in a bad environment. All of a sudden, plus 4% or plus 0%, if you have money in cash, is looking really good. You have to think about the longer term today.
Right, and this is the interesting comment, is I'm buying these other assets because I think the stock market's going to crash. I mean, there's all these people running around, oh, the stock market's going to crash by 50%, so I'm going to go buy Bitcoin, whatever, I'm going to protect myself from the crash. But you just showed us the R squared to liquidity in markets, right? And there's a very high correlation between assets like Bitcoin and stocks are very closely correlated. So putting Bitcoin in the safe bucket of your portfolio is not a great idea, because you're putting a highly correlated risk asset in your safety money bucket. When you're buying bonds, you're buying them for the duration. I'm not buying bonds for a trade. If you're trading bonds, that's a different story. That's the point we're making. There's a lot of claims out there giving bad advice to people saying, oh, ditch your 40% allocation. That's your safe money. That's the money that will be there when you get ready to retire or for whatever your goal is. It will mature at face value. It will give you a return. You will have that asset. That is not guaranteed with any other thing that you own. But you buy treasuries, those are going to be a guaranteed return in the future.
Catch me daily on The Real Investment Show. The link is in the description.